Tonight, we're going to talk about something that's going to completely reshape how you think about money, about value, about everything you thought you knew, about why a piece of paper in one country can be exchanged for goods in another. We're going to explore why currencies hold value across international borders, a phenomenon so fundamental to modern life that we take it completely for granted. And I have to warn you right now, by the end of this, you're going to look at every dollar bill in your wallet very differently. You're going to understand something that most people, even most economists, never fully articulate. Something that makes even massive gold reserves look like just one small piece of a puzzle that spans psychology, history, institutions, and the collective belief of billions of people. If you enjoy these deep explorations into finance and the invisible forces that shape our world, consider subscribing or hitting the like button. It really helps the channel grow and allows me to keep making content like this. Let's begin with something you probably did today. You bought something. Maybe it was coffee. Maybe it was lunch. Maybe it was gas for your car. You handed over monies or tapped a card that represented money, and you received something of value in return. Let's say it was a $5 bill for coffee. That bill is a piece of paper, cotton and linen fiber, actually, with some ink. The physical materials are worth maybe 5 cents. Yet you gave it to someone, and they gave you coffee worth several dollars. Why did they accept it? The answer seems obvious. Because they can use that $5 bill to buy something else. They can pay their supplier. They can pay their employees. They can deposit it in a bank. The bill has value because other people will accept it. But why will other people accept it? Because still other people will accept it from them. This is circular reasoning. Money has value because people believe it has value, because other people believe it has value. This circularity is actually the foundation of how currency works. It's a collective belief system, a shared hallucination. Some economists call it. But it's not just belief. There are institutions, mechanisms, policies that maintain and reinforce this belief. Within a single country, the belief is relatively straightforward. The government declares the currency legal tender. It requires that debts can be settled with it. It collects taxes in it. This creates baseline demand. But across borders, it gets more complex. Why would someone in Japan accept US dollars? The dollar isn't legal tender in Japan. The Japanese government doesn't collect taxes in dollars. Japanese debts are denominated in yen, not dollars. Yet dollars are accepted in Japan. Not everywhere, not for every transaction, but in many contexts. Hotels accept dollars. Currency exchange booths convert dollars to yen. Japanese exporters eagerly accept dollars as payment. Why? This is the question we're going to explore. Not just why dollars are accepted internationally, though that's part of it, but why any currency holds value across borders. What makes a piece of paper from one country exchangeable for goods, services, or other currencies in other countries? The answer is layered, complex, and reveals something profound about human cooperation and trust at a global scale. Before we can understand international currency value, we need to understand domestic currency value. Let's start with the United States and the dollar. There are approximately $2.3 trillion in physical currency in circulation. That's actual paper bills and coins. $2.3 trillion. If you tried to count it, $1 per second, it would take you approximately 73,000 years. But physical currency is only a small fraction of total dollars. Most dollars exist only as electronic entries in bank accounts. The total M2 money supply, which includes physical currency plus checking accounts, savings accounts, and other easily accessible deposits, is approximately $21 trillion. $21 trillion. About 90% of it exists only as numbers in computer system. These dollars have value because VERS, the government declares them legal tender. By law, dollars must be accepted for all debts, public and private, in the United States. If you owe monies, offering to pay in dollars settles the debt. The creditor cannot refuse. Second, the government demands taxes be paid in dollars. The U.S. government collects approximately $4.9 trillion in taxes annually. Every individual, every business needs dollars to meet their tax obligations. This creates fundamental demand for the currency. Third, the Federal Reserve controls the supply. They can create new dollars through monetary policy, or reduce the supply by selling assets and removing dollars from circulation. This supply control helps maintain stability. Fourth, the entire legal and financial system is denominated in dollars. Contracts specify dollar amounts. Court judgments award dollars. Financial instruments are priced in dollars. Unwinding this would be impossibly complex. Fifth, people have confidence in the dollar's future purchasing power. They believe that a dollar tomorrow will buy roughly what a dollar buys today. This isn't always true. Inflation erodes purchasing power over time, but the erosion is usually slow and predictable. These factors combine to create a stable domestic currency. People accept dollars because they're confident they can use those dollars later. Businesses accept dollars because they can pay suppliers and employees with them. The system is self-reinforcing. But notice what's missing. There's nothing inherently valuable about the dollars themselves. The U.S. abandoned the gold standard in 1971. Before that, dollars were theoretically convertible to gold at a fixed rate. This provided a physical anchor to value. Since 1971, dollars have been pure fiat currency. They're valuable only because people believe they're valuable and because institutions support that belief. This seems precarious. A system built on belief could collapse if belief wavers. And sometimes it does. We've seen currency collapses in various countries. Hyperinflation in Zimbabwe, Venezuela, Weimar Germany. When people lose confidence, they stop accepting the currency. It becomes worthless. But in stable countries with strong institutions, the belief holds. The dollar has maintained value for over a century. The euro, the yen, the pound, the Swiss franc, these currencies have been stable for decades. This domestic stability is the foundation for international value. If a currency doesn't hold value at home, it certainly won't hold value abroad. But domestic stability alone doesn't explain international acceptance. There's another layer. Let's trace how currency value extends beyond borders. Starting small. You're an American tourist in Paris. You have dollars. You need euros to buy things. You go to a currency exchange. You hand over $100. The exchange gives you approximately 90 euros, depending on the current exchange rate. Why does the exchange accept your dollars? Because they can do several things with those dollars. They can sell them to French tourists going to America who need dollars. They can sell them to French businesses that need to pay American suppliers. They can sell them to banks that manage international currency holdings. They can sell them in the forex market to currency traders. In other words, the exchange accepts dollars because there's demand for dollars. Why is there demand? Because the dollar is useful internationally. American goods and services need to be paid for in dollars. Investments in American assets require dollars. Many international transactions are denominated in dollars. This creates a feedback loop. Dollars are useful internationally, so people want them, so they are accepted internationally, which makes them more useful, which increases demand. But not all currencies have this quality equally. Try taking Indonesian rupiah to a currency exchange in New York. You'll find it difficult to exchange, and you'll get a very poor exchange rate if you can. Why? Because there's limited demand for rupiah in the United States. Very few Americans need rupiah. Few American businesses deal with Indonesia. The currency isn't widely traded, so the exchange has difficulty finding buyers for the rupiah you want to sell. This illustrates an important point. Currency value across borders is related to demand for that currency internationally. Major currencies like the dollar, euro, yen, pound, they're in high demand globally. They're easily exchangeable almost anywhere. Exchange rates are competitive. Smaller currencies are accepted primarily in their home regions. Exchange rates are less favorable. Availability is limited. At the tourism level, this is an inconvenience. At the trade level, it's fundamental. Let's scale up. Instead of a tourist exchanging hundreds of dollars, let's look at a company trading millions. A German company sells machinery to an American company for 1 million euros. The American company has dollars, not euros. They need to convert. They go to their bank. The bank exchanges 1 million euros worth of dollars, maybe $1.1 million at current rates, and transfers euros to the German company. But here's where it gets interesting. Often, the transaction doesn't happen in euros at all. It happens in dollars. The German exporter invoices the sale in dollars instead of euros. The American importer pays in dollars. The German company then decides whether to convert those dollars to euros or hold them. Why would a German company accept payment in a foreign currency? Several reasons. First, the dollar is more liquid than the euro in international markets. If the German company needs to make international purchases, dollars might be more useful than euros. Second, many commodities are priced in dollars. If the German company needs to buy oil, copper, or other raw materials, those are typically priced in dollars. Holding dollars reduces conversion costs. Third, the dollar is more stable than many currencies. If the German company trades with multiple countries, dollars provide a stable store of value between transactions. Fourth, keeping dollars might be a strategic choice. If the company expects the dollar to strengthen against the euro, holding dollars could generate currency gains. This pattern repeats globally. Companies accept dollars, even when they are not American companies, even when the trade doesn't involve America. A Chinese company selling to Brazil might invoice in dollars. A Japanese company selling to India might invoice in dollars. An Australian mining company selling to South Korea might invoice in dollars. The result is that approximately 60% of international trade is invoiced in US dollars. 60%. Even though US trade represents only about 11% of global trade. This is called dollar dominance, and it's a key reason why dollars hold value internationally. Because international trade, $32 trillion annually, creates demand for dollars. But there's more to it than just trade invoicing. Here's where currency value across borders becomes truly fascinating. Central banks around the world hold reserves of foreign currency. These aren't small amounts. Total global foreign exchange reserves are approximately $12 trillion. $12 trillion held by central banks in foreign currencies. Why do central banks do this? Why would the Bank of Japan hold dollars? Why would the People's Bank of China hold euros? Several critical reasons. First, to facilitate international trade. When Japanese companies import goods, they often need to pay in foreign currencies, especially dollars. The Bank of Japan holds dollar reserves to ensure Japanese companies can always obtain the currencies they need. Second, to defend their currency's value. If the yen starts falling too rapidly against the dollar, the Bank of Japan can sell dollars from reserves and buy yen, supporting the yen's value. If the yen is rising too rapidly, they can do the opposite. Third, as a financial safety net. During crises, countries might face sudden outflows of capital. Foreign investors might pull money out. Importers might panic buy foreign currency. Having reserves prevents a currency collapse. Fourth, to generate returns. Central banks invest their reserves in foreign bonds, typically government bonds like U.S. Treasuries. These generate interest income for the central bank. Now here's the crucial insight. What currencies do central banks hold in their reserves? Approximately 59% is US dollars. About 20% is euros. About 6% is Japanese yen. About 5% is British pounds. About 3% is Chinese yuan. The rest is distributed among other currencies. This means approximately $7 trillion worth of central bank reserves are held in US dollars. $7 trillion. Central banks around the world holding dollars because they need dollars, because they value dollars, because dollars are the most useful reserve currency. This creates fundamental demand for dollars. Not speculative demand, not temporary demand. Structural, long-term, institutional demand from the most important financial institutions in every country. And here's what's remarkable. These central banks could, theoretically, decide not to hold dollars. They could sell their dollar reserves and buy euros or gold or yuan. But they don't. Because dollars are the most liquid, most useful, most trusted reserve currency. This isn't just habit, it's rational choice based on the dollar's properties. The dollar is accepted everywhere. You can convert dollars to any other currency instantly at tight spreads. The market for dollars is the deepest, most liquid financial market in the world. U.S. Treasury bonds, which is where central banks hold most dollar reserves, are considered the safest assets in the world. The U.S. government has never defaulted. The bonds are highly liquid, tradable in enormous volumes without moving prices. The dollar's value is relatively stable. Yes, it fluctuates. But compared to most currencies, the dollar maintains purchasing power reasonably well over time. These factors make the dollar the obvious choice for reserves, which creates demand for dollars, which supports the dollar's value, which makes it more attractive as a reserve currency. Self-reinforcing. But reserves are just one source of international currency demand. There's another, even larger. Debt creates demand for currency. If you borrow dollars, you eventually need to repay in dollars. This creates future demand. At the international level, this effect is massive. Total international debt securities, bonds and loans denominated in currencies other than the borrower's domestic currency, amount to approximately $65 trillion. $65 trillion in international debt. And the majority of this debt is denominated in U.S. dollars. Companies and governments around the world have borrowed approximately $13 trillion in dollar-denominated bonds. That's debt issued by non-U.S. entities in dollars. Why would a Brazilian company borrow in dollars instead of reais? Why would the Turkish government issue dollar bonds instead of lira bonds? Because international investors prefer lending in dollars. If you're a global investor with capital to deploy, you want to lend in a stable, predictable currency. The Brazilian real can fluctuate wildly. The Turkish lira even more so. The dollar is more stable. So Brazilian companies pay lower interest rates if they borrow in dollars instead of reais. Turkish government bonds sell better if they are denominated in dollars. This creates a trap. The Brazilian company borrows dollars when the exchange rate is, say, 5 reais per dollar. They convert those dollars to reais and use the money for operations in Brazil. Years later, when the debt matures, they need to repay in dollars. But now the exchange rate might be 7 reais per dollar. The real has weakened. The company needs 40% more reais to buy the dollars necessary to repay the debt. Their debt burden, in real terms, has increased by 40%. Not because of interest, because of currency movement. This happened across Asia in 1997. Countries like Thailand, Indonesia, South Korea, they had borrowed heavily in dollars. When their currencies collapsed, their dollar-denominated debt became unpayable. Countries and companies went bankrupt. Despite this risk, the pattern continues. Borrowers want the lower interest rates that come with dollar-denominated debt. Lenders want the stability of dollar-denominated claims. And every dollar of this debt creates future demand for dollars. When a Turkish bond matures, the Turkish government needs to obtain dollars to repay it. When a Brazilian company makes interest payments, they need dollars every quarter. $65 trillion in international debt, much of it denominated in dollars, creates ongoing, structural demand for dollars. This demand supports the dollar's value across borders. People know there will always be borrowers who need dollars to service debt. This makes dollars valuable, which makes people willing to accept dollars in exchange for goods or other currencies. But even $65 trillion in debt doesn't capture the full picture. There's another dimension. The foreign exchange market, (Forex), is where currencies are bought and sold. It's the largest financial market in the world. Daily trading volume is approximately $7.5 trillion. $7.5 trillion every single day. To put that in perspective, that's more than all the world's stock markets combined. That's more than all bond markets. The Forex market dwarfs everything else. Most of this trading involves the dollar. Approximately 90% of Forex trades involve the dollar on one side of the transaction. Why so much trading? Several reasons. First, international trade. Companies need to convert currencies to pay for imports and receive payment for exports. $32 trillion in annual trade creates trillions in currency conversion needs. Second, investment flows. When a Japanese investor buys US dog, they need to convert yen to dollars. When an American investor buys European bonds, they convert dollars to euros. Cross-border investment flows are enormous, creating constant currency trading. Third, hedging. Companies with foreign currency revenues or expenses use Forex markets to hedge their currency risk. Banks hedge their currency exposures. This hedging activity generates massive trading volumes. Fourth, speculation. Traders try to profit from currency movements. They buy currencies they expect to strengthen and sell those they expect to weaken. This speculative activity adds liquidity to markets. Fifth, arbitrage. When exchange rates differ slightly between markets, traders exploit these differences. This keeps exchange rates consistent globally. The depth and liquidity of the Forex market is crucial for currency value. If you hold euros and want to convert to yen, you can do so instantly in any amount at transparent prices. The spread, the difference between buying and selling prices, is typically a fraction of a percent. This liquidity makes currencies useful. You can move from one currency to another without significant cost or delay. This utility supports currency value. But liquidity isn't evenly distributed. The dollar-euro pair is the most traded, about 1.1 trillion in daily volume. Dollar-yen is second, about 600 billion daily. Dollar-pound is third, about 400 billion. These major pairs have excellent liquidity. You can trade hundreds of millions with minimal market impact. But try trading Indonesian rupiah for Chilean pesos. The market is thin. Spreads are wide. You might need to convert rupiah to dollars, then dollars to pesos, paying spreads twice. This is why the dollar is used as an intermediary currency. Even when the ultimate transaction is between two non-dollar currencies, it often routes through dollars because dollar liquidity is so superior. This intermediation role creates additional demand for dollars. Even transactions that don't ultimately involve dollars temporarily create dollar demand during the conversion process. The Forex market By being dollar-centric, reinforces dollar value internationally. Let's step back and recognize the pattern. Currency value across borders exhibits strong network effects. A network effect means a product or service becomes more valuable as more people use it. Telephones exhibit network effects. A phone is worthless if you're the only person with one. It becomes valuable when millions of people have phones you can call. Social networks exhibit network effects. Facebook is valuable because billions of people use it. A competing social network with only a few users has little value. Currencies exhibit the same dynamic. The dollar is valuable internationally because international trade is invoiced in dollars. Central banks hold dollar reserves. International debt is denominated in dollars. The forex market is dollar-centric. Each of these factors reinforces the others. Trade is invoiced in dollars because that's what central banks hold. Central banks hold dollars because that's what trade is invoiced. Circular, but powerfully self-reinforcing. This creates enormous inertia. Even if another currency, say the euro or yuan, had superior properties, displacing the dollar would be difficult. Everyone would need to coordinate a switch. Exporters would need to start invoicing in the new currency. Importers would need to accept it. Central banks would need to shift their reserves. Borrowers would need to issue debt in it. Forex markets would need to develop depth. This coordination problem is massive. It's easier for everyone to just keep using dollars. This is why the dollar became dominant in the first place. After World War II, the US was the world's largest economy. The dollar was backed by gold. The US championed free trade and open markets. Countries needed dollars to buy American goods and to purchase oil, which was priced in dollars. The dollar became the default currency for international transactions. And once it was the default, network effects locked it in. Before the dollar, the British pound played this role. In the 19th and early 20th centuries, the pound was the dominant reserve currency. International trade was invoiced in pounds. Central banks held pound reserves. The pound's dominance persisted for decades after Britain's economic primacy faded. Network effects and inertia. It took 2 world wars and a major financial crisis to dislodge the pound. The dollar has been dominant since the 1940s. Over 80 years. Despite America's share of global GDP declining from about 40% then to about 25% now, the dollar's international role has actually strengthened in some ways. Network effects are powerful, but they are not permanent. Networks can be disrupted. Dominance can shift. It just takes a major shock or a slow, coordinated evolution. Not all currencies are created equal. Some hold value across borders better than others. The Swiss franc is accepted worldwide, readily convertible, trusted. The Venezuelan bolivar is nearly worthless outside Venezuela, difficult to exchange, unstable. What creates this difference? Trust. Trust in what, specifically? Several things. First, trust in the government's fiscal discipline. Will the government print excessive amounts of currency? Will they run unsustainable deficits? Will they default on debt? Switzerland has a long history of conservative fiscal policy, low debt levels, balanced budgets, no defaults. This history creates confidence that the Swiss franc will maintain value. Venezuela, by contrast, has printed money recklessly to finance government spending. Inflation reached millions of percent annually. The currency became worthless. Once a government destroys currency value, rebuilding trust takes decades. Argentina has defaulted on debt 9 times in its history. Even when the government tries to implement sound policies, people remember. They are reluctant to hold pesos long term. Second, trust in the central bank's independence and competence. Will the central bank maintain low and stable inflation? Will they resist political pressure to print money? Will they manage crises effectively? The Federal Reserve, the European Central Bank, the Bank of Japan, they've maintained inflation at generally low levels for decades. They've managed financial crises without destroying currency value. They've proven competent. By contrast, central banks in many developing countries lack independence. They're pressured by governments to finance spending. They prioritize political goals over price stability. This destroys confidence. Third, trust in the rule of law and property rights. Can the government arbitrarily seize assets? Can they impose capital controls, preventing you from converting currency? Are contracts enforced? In countries with strong rule of law, like the US, UK, Switzerland, Japan, people are confident their assets are secure. This makes the currency more valuable. In countries where governments routinely seize assets, impose capital controls, or fail to enforce contracts, people are reluctant to hold wealth in the local currency. They convert to dollars or euros or gold at the first opportunity. Fourth, trust in economic stability. Is the economy growing? Is unemployment low? Are living standards rising? Economic strength supports currency value. A growing economy with rising productivity can maintain currency value even with some inflation. A shrinking economy with declining productivity struggles to maintain currency value. Fifth, trust in geopolitical stability. Is the country likely to face war, revolution, or major political upheaval? The U.S. hasn't faced war on its territory since the Civil War. Its political system, despite partisan divisions, has proven remarkably stable. Power transitions happen peacefully. This stability supports the dollar. Countries experiencing civil war, coups, or major instability see their currencies collapse. Syria, Libya, Lebanon, their currencies lost most of their value during recent conflicts. These trust factors combine to create tiers of currencies. Tier 1. Reserve currencies. Dollars, euros, yen, pounds, Swiss franc. Widely accepted globally, highly liquid, stores of value. Tier 2. Major emerging market currencies. Chinese yuan, Indian rupee, Brazilian real, Mexican peso. Accepted in their regions, convertible but with wider spreads, less trusted long-term. Tier 3. Smaller stable currencies. Australian dollar, Canadian dollar, South Korean won, Singapore dollar. Fully convertible, stable, but limited international use. Tier 4. Developing country currencies. Egyptian pound, Nigerian naira, Pakistani rupee, partially convertible, prone to volatility, accepted primarily domestically. Tier 5. Unstable currencies. Venezuelan bolivar, Lebanese pound, currencies in hyperinflation or crisis. Essentially worthless outside their borders, often worthless within them. The tier determines how easily a currency holds value across borders. There's a theoretical framework for understanding currency value. Purchasing power parity, PPP. The basic idea is simple. In the long run, exchange rates should adjust so that identical goods cost the same in different countries. If a Big Mac costs $5 in the US and €4 in Germany, the exchange rate should be $1.25 per euro. Otherwise, you could make money buying Big Macs where they're cheap and selling where they are expensive. Of course, you can't actually do this with Big Macs. They're not easily transportable, but the logic applies to tradable goods generally. If goods are much cheaper in one country than another when converted at market exchange rates, eventually trade will flow to exploit the difference. Importers will buy from the cheap country. Exporters will sell to the expensive country until prices equalize. This creates a gravitational pull toward PPP exchange rates. But PPP is only a long-run tendency. In the short and medium run, exchange rates deviate significantly from PPP. Why? Because currency values are driven by capital flows, not just trade flows. If international investors suddenly want to buy Japanese stocks, they need yen. Demand for yen increases. The yen strengthens. This has nothing to do with PPP. If a country experiences a financial crisis and capital flees, demand for the currency collapses. The currency weakens far beyond what PPP would suggest. Interest rate differentials also matter. If U.S. interest rates are higher than European rates, investors might prefer holding dollars to earn the higher yield. This pushes the dollar above its PPP level. Over decades, currencies tend to revert toward PPP levels. But the path is erratic, and temporary deviations can last years. PPP provides a fundamental anchor, but other forces dominate short-term movements. Currency value is psychological as much as economic. If people believe a currency will strengthen, they want to hold it. Demand increases. The currency strengthens. The belief becomes self-fulfilling. If people believe a currency will weaken, they want to sell it. Supply increases. Demand falls. The currency weakens. Again, self-fulfilling. This creates potential for bubbles and crashes. In the late 1990s, the dollar strengthened significantly. International capital flowed into U.S. stocks during the dot-com boom. The strong dollar attracted more capital, which strengthened the dollar further. Positive feedback loop. When the dot-com bubble burst, capital flowed out. The dollar weakened. Negative feedback loop. These psychological dynamics can be extreme in crisis. The Asian financial crisis of 1997 started in Thailand. The Thai baht came under pressure due to excessive debt and current account deficits. Investors lost confidence. They sold baht. The currency collapsed. Then contagion spread. Investors thought, if Thailand is vulnerable, What about Indonesia? What about South Korea? What about the Philippines? They sold those currencies too. Even countries with better fundamentals saw their currencies collapse. Pure psychology, fear and contagion. Central banks tried to defend their currencies by raising interest rates and spending reserves to buy their own currency. But reserves are limited. Eventually, they ran out. Currencies collapsed. The psychological dimension means currency value is fragile. Confidence can evaporate quickly. Once lost, it's hard to restore. This is why central bank credibility is so important. If the central bank has established trust over decades, people give them the benefit of the doubt during crises. If the central bank lacks credibility, people assume the worst. Self-fulfilling prophecy. The psychology of currency value also explains flight to quality. During global crises, investors sell risky assets and currencies and buy safe ones. The dollar, yen, and Swiss franc typically strengthen during crises, even when the crisis doesn't directly affect those countries. Why? Because investors trust those currencies to hold value. Psychological safe havens. This flight to quality reinforces the dominance of major currencies. During every crisis, the dollar proves its value as a safe haven. This builds confidence, making it more likely to be a safe haven in the next crisis. Self-reinforcing. Understanding why currency holds value across borders requires historical context. For most of human history, currency meant gold and silver. These metals had intrinsic value. They were scarce, durable, divisible, universally desired. Gold coins from ancient Rome could be traded in ancient China. The medium didn't matter, only the gold content. This was true cross-border value. As banking developed, paper currency emerged. But initially, paper was just a claim on gold or silver. You could take paper money to a bank and exchange it for metal. International currency systems were built on this foundation. The gold standard, which operated from the late 1800s to 1914, fixed exchange rates based on gold content. A pound sterling contained a certain amount of gold. A dollar contained a certain amount of gold. The exchange rate was simply the ratio of their gold contents. This system provided stability and predictability. Exchange rates were fixed. No currency risk. International trade flourished. But it also created rigidity. Countries couldn't adjust exchange rates to respond to economic conditions. If a country faced recession, it couldn't devalue to boost exports. The only adjustment mechanism was deflation, which was painful. World War I destroyed the gold standard. Countries printed money to finance the war effort. Currency values diverged from gold content. Hyperinflation hit several countries. Attempts to restore the gold standard in the 1920s failed. The Great Depression and World War II finished it off completely. After World War II, the Bretton Woods system was established. The dollar was pegged to gold at $35 per ounce. Other currencies were pegged to the dollar at fixed rates. Essentially, a dollar-based gold standard. This system lasted until 1971. U.S. inflation and growing trade deficits made the gold peg unsustainable. Nixon closed the gold window, ending dollar convertibility to gold. Since then, we've had a pure fiat currency system. No currencies are backed by gold or any other commodity. Value is based purely on trust, institutions, and collective belief. This system is historically unprecedented. For the first time, international currency values are determined entirely by market forces, psychology, and policy decisions. It's more flexible than the gold standard. Countries can adjust exchange rates to respond to shocks. Central banks can manage liquidity. But it's also more fragile. Without a physical anchor, confidence can evaporate. Currency crises are more common. Exchange rates are more volatile. The modern system has produced both remarkable stability in major currencies and spectacular failures in weaker ones. The dollar, euro, yen, they've maintained value for decades under the fiat system. But dozens of other currencies have experienced hyperinflation, collapse, or crisis. This bifurcation reflects the importance of institutions and trust. Countries with strong institutions can operate fiat currencies successfully. Countries with weak institutions struggle. The dollar's international dominance faces challenges. Some structural, some political, some technological. First, the weaponization of the dollar. The U.S. government has increasingly used access to the dollar financial system as a tool of foreign policy. Countries, banks, and individuals can be cut off from dollar transactions through sanctions. This works because the dollar is so dominant. If you can't access dollars, you can't participate in much of international trade and finance. But the more the U.S. uses this weapon, the more other countries seek alternatives. Russia, China, Iran, they're actively trying to reduce dollar dependence. They're promoting trade in local currencies. They're building alternative payment systems. They're accumulating gold reserves instead of dollar reserves. This won't dethrone the dollar quickly. Network effects are too strong, but it creates slow erosion. Second, U.S. fiscal deficit. The U.S. government runs persistent budget deficits. Federal debt is now about 134% of GDP, over $34 trillion. At some point, this debt burden could undermine confidence in the dollar. If investors worry the U.S. will inflate away the debt, they'll demand higher interest rates on Treasury bonds. This could create a debt spiral. So far, this hasn't happened. The U.S. is still seen as creditworthy. Treasury bonds are still considered the safest asset. But the trajectory is concerning. Third, the rise of China. China is the world's second largest economy, the largest trading nation, the largest manufacturer. Yet the yuan represents only about 3% of global reserves. This disconnect creates opportunity. China is actively promoting yuan internationalization. They've established currency swap lines with many countries. They've created clearing banks for yuan transactions globally. They're pricing some oil imports in yuan. The yuan's share of international payments has grown from essentially zero in 2010 to about 4 to 5% today. Still small, but growing. And if China's economy continues growing relative to the US, the yuan could eventually rival the dollar. But China faces obstacles. The yuan isn't freely convertible. Capital controls restrict flows in and out of China. Chinese financial markets are less transparent and less liquid than US markets. These factors limit the yuan's international appeal. Fourth, the euro as an alternative. The euro is the second largest reserve currency, at about 20% of global reserves. The Eurozone economy is comparable in size to the US economy. European financial markets are deep and liquid. The European Central Bank has proven credibility. The euro could potentially increase its international role. But the Eurozone faces its own challenges. Political fragmentation, sovereign debt concerns in some member states, banking system weaknesses. The euro also lacks a unified fiscal policy, or Eurobonds, that could serve as a true alternative to U.S. treasuries. This limits its appeal as a reserve currency. Fifth, digital currencies. Central bank digital currencies, CBDC, could change international currency dynamics. If major central banks issue digital versions of their currencies, cross-border payments could become instant and low-cost. This might reduce dollar intermediation. Countries could trade in their own currencies more easily. China is furthest along, with the digital yuan already in pilot programs. The ECB is developing a digital euro. The US is exploring a digital dollar. These developments could fragment the international currency system, or they could create new forms of integration. The implications are still unclear. Cryptocurrencies like Bitcoin are another alternative. Some advocates claim they could replace national currencies for international transactions. But cryptocurrencies have struggled to gain traction for real economic activity. They are too volatile. Transaction costs are often high. Scalability is limited. Governments resist them. Stable coins, cryptocurrencies pegged to traditional currencies, might have more potential. They combine crypto's technology with the stability of fiat currencies. But stablecoins still depend on the underlying currencies. A dollar-pegged stablecoin just extends dollar dominance into digital form. The challenges to dollar dominance are real but slow-moving. Absent a major crisis or policy mistake, the dollar will likely remain dominant for decades. But the trend is toward a more multipolar currency system, with the dollar's share gradually declining as other currencies grow. Understanding why currency holds value requires understanding when it doesn't. Currency collapses have occurred repeatedly throughout history. The pattern is instructive. Hyperinflation in Weimar Germany in the early 1920s saw prices doubling every few days. The mark became worthless. People needed wheelbarrows of cash to buy bread. What caused it? The government printed money recklessly to pay war reparations and finance spending. Once inflation accelerated, it became self-reinforcing. People spent money immediately because it lost value by the hour. This increased velocity, which increased inflation, which increased velocity. Vicious cycle. Zimbabwe in the 2000s experienced similar dynamics. Inflation reached billions of percent annually. The government printed $100 trillion notes. Worthless. Venezuela more recently saw its currency lose essentially all value. Oil revenue collapsed. The government printed money to maintain spending. Inflation reached millions of percent. The pattern is consistent. Fiscal crisis leads to money printing. Money printing causes inflation. Inflation destroys confidence. People flee to other currencies. Demand collapses. currency becomes worthless. Once this process starts, it's nearly impossible to stop without severe measures. You need to establish a new currency backed by credible institutions. This requires political stability, fiscal discipline, and usually external support. Argentina has experienced repeated currency crises. Each time, they establish a new currency, sometimes literally renaming the peso. Each time, they promise fiscal discipline. Each time, eventually, the discipline breaks down. The pattern repeats. This history teaches that currency value is contingent. It depends on maintaining institutions and policies that preserve confidence. Once confidence is lost, value evaporates rapidly. It also shows that rebuilding currency value is extremely difficult. Countries that have experienced hyperinflation struggle for decades to restore trust. Interestingly, during currency collapses, people don't abandon currency entirely. They switch to foreign currencies. During Zimbabwe's hyperinflation, people used US dollars, South African rand, Botswana pula, anything stable. Eventually, the government officially dollarized, abandoning the Zimbabwe dollar entirely. Ecuador, El Salvador, Panama, they've all officially adopted the US dollar. They gave up monetary sovereignty to gain currency stability. This demonstrates that when domestic currencies fail, international currencies provide a fallback. The dollar's value across borders becomes a lifeline for countries whose own currencies have collapsed. Gold has been money for thousands of years. Even after currencies left the gold standard, gold retains a special role. Central banks hold approximately 36,000 tons of gold in reserves. At current prices, that's worth approximately $2.3 trillion. $2.3 trillion in gold, held by central banks. Why? Gold serves as a hedge. When paper currencies lose value, gold tends to maintain purchasing power. During crises, gold provides insurance. Gold also has no counterparty risk. If you hold gold, you don't depend on any government or institution honoring a promise. The gold simply exists. This makes gold attractive during periods of geopolitical tension or financial instability. Russia and China have been accumulating gold reserves steadily. Russia increased gold holdings from about 500 tons in 2007 to over 2,000 tons today. Why? To reduce dependence on the dollar. Gold can't be sanctioned or frozen. If you hold gold, no foreign government can prevent you from using it. Some analysts suggest gold could play a larger role in a multipolar currency system. As trust in any single currency declines, gold might serve as a neutral reserve asset acceptable to all parties. But gold has limitations. It doesn't pay interest. Storing it securely is expensive. Transporting large amounts is difficult. Using gold for everyday transactions is impractical. Gold works as a store of value, but not as a medium of exchange or unit of account. For those functions, you need currency. The future likely involves both paper, or more accurately digital, currencies for transactions, gold as an insurance policy, an alternative store of value. This is essentially how the current system operates. And it's probably how the future system will operate too, unless something dramatic changes. Technology is changing how currency works. which affects how value is maintained across borders. Verse. Payment technology. Traditional international payments are slow and expensive. They route through correspondent banks, taking days and costing significant fees. New payment technologies can transfer money instantly at minimal cost. This reduces friction, making it easier to use any currency for international transactions. If you can convert Brazilian reais to Pakistani rupees instantly and cheaply, you don't need to route through dollars. This could reduce dollar intermediation. Second, blockchain and distributed ledger technology. Blockchain enables peer-to-peer currency transfers without intermediaries. Central banks are exploring using blockchain for CBDC. This could make cross-border transactions more efficient. Commercial banks are piloting blockchain for interbank settlements. This could reduce settlement times from days to minutes. If successful, these technologies could reduce the advantage currently enjoyed by currencies with deep, liquid payment networks. It might level the playing field somewhat. Third, artificial intelligence and big data. AI can improve currency risk management, making it easier to hold and transact in multiple currencies. Better hedging tools reduce currency risk, which could increase willingness to use non-dominant currencies. Big data enables more sophisticated currency analysis, helping participants understand value drivers and make better decisions. Fourth, mobile money and digital wallets. In some countries, particularly in Africa and Asia, mobile money systems have become more important than traditional banking. People hold value in mobile accounts, transfer money by phone. These systems could enable new forms of cross-border value transfer, potentially bypassing traditional currency exchange mechanisms. Technology is democratizing access to foreign exchange and international payments. What once required large banks and significant capital can now be done by individuals with smartphones. This could gradually erode the structural advantages of major currencies. Or it could reinforce them by making those currencies even more accessible globally. The direction is uncertain. Technology is a wild card in the evolution of international currency systems. We've explored the mechanisms: trade invoicing, central bank reserves, international debt, forex markets, network effects. But beneath all these mechanisms is a deeper question. What is money? Money is not a physical thing. It's a social construct, a shared agreement about value. Think about it. A dollar bill is paper. The ink and material are nearly worthless. Yet you can exchange it for real goods, for hours of human labor, for tangible assets. Why does anyone accept this exchange? Because they trust they can make similar exchanges with others. Money is essentially a ledger of social obligations. When you receive money for your work, society acknowledges it owes you value equivalent to your contribution. When you spend that money, you're claiming that value back. Currency is just the technology we use to track these obligations. In the past, we used gold coins, then paper backed by gold. Now pure fiat currency and increasingly digital entries. The technology changes, but the fundamental social function remains: tracking who has contributed value and who has claimed it. At the domestic level, this works because we're all part of one society, one legal system, one shared set of institutions. At the international level, it's more complex. Different societies, different legal systems, different institutions. For currency to hold value across borders, we need shared trust in certain institutions, like major central banks, common standards for measuring and transferring value, like forex markets, mechanisms for enforcing obligations, like international banking regulations, and ultimately, collective belief that the system will continue functioning. This collective belief is fragile. It rests on continued cooperation, continued trust, continued functioning of institutions. When cooperation breaks down, when trust is violated, when institutions fail, the system can unravel quickly. We saw this during the World Wars, when international currency systems collapsed. We've seen it in currency crises, when contagion spreads from country to country. But remarkably, the system usually recovers. New arrangements are made. New institutions are built. Trust is gradually restored. This resilience reflects something profound about human nature: our need and ability to cooperate at large scales. Currency that holds value across borders is a testament to global cooperation. Billions of people, thousands of institutions, hundreds of governments, all participating in a shared system of value transfer. It's one of humanity's most impressive achievements, and we take it completely for granted. Currency isn't just about economics. It's about power. The country that issues the dominant international currency gains enormous advantages. Verse, Sinerid, the profit from issuing currency. When other countries hold dollars in reserves, they are essentially lending to the U.S. at very low interest rates. The U.S. can issue debt more cheaply than it otherwise could. This seigniorage benefit is worth hundreds of billions of dollars over time. Second, policy autonomy. The U.S. can run persistent trade deficits because foreign exporters are willing to accumulate dollars. Other countries would face currency crises if they tried the same. The U.S. can impose financial sanctions that affect global commerce. Other countries lack this capability. The Federal Reserve's monetary policy affects the entire world. When the Fed raises rates, capital flows globally respond. Other countries must either match rate increases or accept currency depreciation. This policy autonomy is a major strategic advantage. Third, information advantage. Dollar transactions flow through U.S. financial institutions. This gives the U.S. government visibility into global financial flows. Intelligence agencies can track money movements, identify networks, detect threats. This information advantage has both security benefits and economic benefits. Fourth, resilience. During crises, the dollar strengthens as a safe haven. Other countries see their currencies weaken, making imports more expensive, creating economic stress. The U.S. benefits from its currency's strength. These advantages explain why currency dominance is geopolitically significant. China's push to internationalize the yuan isn't just economic. It's strategic. Yuan internationalization would give China similar advantages to what the U.S. currently enjoys. It would reduce China's vulnerability to U.S. sanctions. It would increase China's policy autonomy. It would enhance China's global influence. Europe's promotion of the euro has similar motivations. A stronger international role for the euro would increase European autonomy vis-à-vis the US. Currency competition is geopolitical competition. It's about who sets the rules, who has autonomy, who bears adjustment costs when the system faces stress. This dimension will become more important as geopolitical tensions rise. Currency systems could increasingly reflect geopolitical alignments. A US-aligned bloc using the dollar, a China-aligned bloc using the yuan, a European bloc using the euro, other countries trying to navigate between them. This would be less efficient than the current dollar-dominated system. More currency conversions, more hedging costs, more complexity. But it might be politically preferable to accepting one country's dominance. The future international currency system will reflect both economic efficiency and political considerations. Power and money are inseparable. So what does all this mean for you as an individual? First, understand that your money's value isn't guaranteed. Currency value depends on institutions, policies, and collective confidence. These can change. What seems stable can become unstable relatively quickly. This doesn't mean panic. Major currencies like the dollar, euro, yen, they're backed by strong institutions and are likely to remain stable. But understanding the contingency helps you make better decisions. Second, consider currency diversification. If you hold all your wealth in one currency, you're exposed to that currency's fluctuations. Holding some assets in other currencies or in currency-neutral assets like real estate or stocks can reduce risk. This is particularly relevant if you live in a country with a volatile currency. Holding some dollars or euros might provide valuable insurance. Third, pay attention to exchange rates if you travel or do business internationally. Exchange rates affect the real cost of everything you buy abroad. A strong home currency makes foreign travel cheaper. A weak home currency makes it more expensive. If you do business internationally, currency fluctuations can have major impacts on profitability. Understanding currency dynamics helps you manage these risks. Fourth, recognize that currency policy affects you even if you never leave your country. Central bank decisions about interest rates and money supply affect inflation, employment, asset prices. Exchange rate movements affect import prices. Currency crises can trigger recession. Being informed about currency dynamics helps you understand economic news and make better financial decisions. Fifth, if you're choosing where to hold long-term savings, currency stability matters. Saving in a currency that loses value through inflation or depreciation erodes your wealth. Saving in stable currencies preserves purchasing power. This is why people in countries with unstable currencies often try to save in dollars or euros. Even if it's inconvenient or technically illegal, the stability is worth it. Sixth, support policies that maintain currency stability. Sound fiscal policy, central bank independence, rule of law. These institutions that maintain currency value affect your economic well-being. When politicians promise easy money, free spending, printing money to solve problems, be skeptical. These policies often end badly, destroying currency value and hurting ordinary people. Currency value is a public good. Like clean air or safe streets, everyone benefits when it's maintained. Everyone suffers when it's destroyed. Understanding how currency value works empowers you to protect your own interests and advocate for policies that benefit society. Looking forward, the international currency system could evolve in several directions. Scenario 1. Continued dollar dominance. In this scenario, network effects and inertia keep the dollar as the primary international currency. The U.S. maintains fiscal discipline, the Federal Reserve maintains credibility, and no viable alternative emerges. The dollar's share of reserves might decline modestly, from 60% to maybe 50%, but it remains clearly dominant. This is the path of least resistance. It requires no major changes or coordination. It's the most likely scenario in the absence of shocks. Scenario 2. Multipolar currency system. In this scenario, the dollar, euro, and yuan all play significant international roles. No single currency dominates. The dollar might fall to 35 to 40% of reserves. The euro rises to 30%. The yuan rises to 20%. Other currencies fill the remainder. This would be more complex. More currency conversions needed. More hedging required. Higher transaction costs. But also more balanced. No single country has overwhelming advantage. This scenario requires significant Chinese financial reforms, opening capital accounts, making the yuan fully convertible. It also requires the euro area to resolve its structural issues. Possible, but would take decades. Scenario 3. Digital currency revolution. In this scenario, central bank digital currencies, or a new global digital currency, becomes the primary means of international value transfer. National currencies might still exist for domestic use, but international transactions would use a digital medium. Perhaps a basket-backed digital currency, or a decentralized cryptocurrency that achieves stability and scale. This would be the most disruptive scenario. It would require building entirely new infrastructure, new institutions, new regulatory frameworks. It's the least likely scenario in the near term. But technological change can be surprisingly rapid. What seems impossible can become inevitable in a short time. Each scenario has different implications for currency value across borders. In Scenario 1, the mechanisms we've discussed remain mostly unchanged. In Scenario 2, currency value becomes more fragmented, with different currencies dominating in different regions or sectors. In Scenario 3, currency value might depend more on technology and protocol design than on national institutions. The most likely outcome is probably a blend. Continued dollar dominance with gradual erosion, increasing role for other major currencies, and slow adoption of digital currencies that supplement rather than replace traditional currencies. Change in currency systems is usually evolutionary, not revolutionary. Absent major crisis, the system 20 years from now will probably look recognizably similar to the system today, just with shifted proportions and new technological infrastructure. We've journeyed from a $5 bill in a coffee shop to the $12 trillion in global foreign exchange reserves. From one transaction to $7.5 trillion in daily forex trading. From a single currency to the complex web of trust that binds the global economy together. Let's synthesize what we've learned. Currency holds value across borders because of interlocking layers of trust. Trust in institutions. Central banks that manage money supply responsibly. governments that maintain fiscal discipline, legal systems that enforce contracts and property rights, trust in mechanisms, forex markets that provide liquidity, payment systems that move money reliably, banking networks that facilitate international transactions, trust in economic fundamentals, countries with growing, productive economies, trade that creates demand for currencies, debt obligations that require currencies for repayment, trust in stability, political systems that transition power peacefully, countries that avoid wars and revolutions, currencies with track records of maintaining purchasing power, and ultimately, trust in collective belief, the confidence that tomorrow others will accept the same currency you accept today, that the system will continue functioning, that value will be preserved. This trust is not naive. It's based on rational assessment of institutions, track records, and incentive. But it's also self-fulfilling. Currency has value because people believe it has value. The remarkable achievement of the modern international currency system is that this collective belief spans borders, cultures, legal systems, and political divides. A dollar earned in New York holds value in Tokyo, in London, in Sao Paulo. Not because the U.S. government has authority in those places, but because institutions and mechanisms have been built that make the dollar useful, liquid, and trusted globally. This didn't happen by accident. It was constructed over decades, through institutions like the IMF and World Bank, through agreements like Bretton Woods, through the development of global banking networks, payment systems, forex markets, and it's maintained daily through countless transactions, decisions, and relationships that reinforce the system. When you exchange dollars for euros, you're participating in this system. When a Japanese company accepts dollars for payment, they're validating the dollar's international role. When the Bank of China holds dollar reserves, they're supporting the dollar's value. Every participant reinforces the system through their choices, and the system reinforces itself through network effects. This is the essential truth. Currency holds value across borders because billions of people and thousands of institutions cooperate, implicitly and explicitly, to maintain a shared system of value. It's one of the most complex cooperative endeavors in human history. And it works. Mostly. But the system is not invulnerable. We've seen currency collapses. We've seen financial crises that disrupted international payments. We've seen trust evaporate and value destroyed. The system's fragility comes from its psychological foundation. Because currency value depends on belief, belief can change. Confidence can turn to panic. Currency crises can spread through contagion. A country with seemingly sound fundamentals can experience currency collapse if confidence wavers. Self-fulfilling prophecies work in both directions. The system's resilience comes from its institutional foundation. Strong central banks, rule of law, deep financial markets, these provide ballast during storms. Major currencies like the dollar, euro, yen, they've weathered numerous crises. The institutions supporting them have proven resilient. But resilience isn't guaranteed. It requires active maintenance. Sound policies, capable institutions, international cooperation. When these break down, even major currencies can face severe stress. We saw this in the euro crisis of 2010 to 2012, when the euro's survival was questioned. We saw it in the 1970s, when dollar convertibility to gold ended and the international monetary system was restructured. The system is fragile and resilient simultaneously. Fragile because it rests on confidence. Resilient because institutions and mechanisms have been built to maintain that confidence. Understanding this duality is crucial. It means we can't take currency value for granted. It requires vigilance, good policy, and continued cooperation. But it also means the system can withstand significant stress. It's been tested repeatedly. Wars, depressions, financial crises, technological change. The system adapts and persists. This adaptability is perhaps the system's greatest strength. Currency mechanisms have evolved from gold coins, to paper backed by golds, to pure fiat currency, to increasingly digital money. The form changes, but the function persists. The future will bring more change. Digital currencies, new payment technologies, shifting geopolitical alignments. The system will adapt again. What matters is preserving the core functions. A reliable store of value, an efficient medium of exchange, a stable unit of account. As long as currencies provide these functions across borders, they'll hold value. How they provide these functions will evolve, but the need for them won't. Here's what strikes me most about currency value across borders. It reveals humanity's capacity for large-scale cooperation. We're a species that evolved in small groups. For most of human history, our social networks extended to maybe 100 or a few hundred people. Trust was personal. Reputation was face-to-face. Currency that holds value across borders requires trust at a scale orders of magnitude larger. When you accept dollars, you're trusting not just the person handing them to you, but an entire system spanning the globe. The Federal Reserve, the U.S. government, thousands of banks, millions of businesses, billions of individuals. You're trusting that this complex system will continue functioning, that institutions will maintain their roles, that policies will remain reasonably sound, that collective belief will persist. This is an extraordinary form of trust, and it works. Yes, imperfectly. Yes, with crises and failures. But the default state is functioning. The system usually works. This represents a profound expansion of human cooperation. From trust in people we know personally, to trust in institutions we've never seen, to trust in abstract systems of rules and mechanism. Currency value across borders is possible because we've developed institutions and technologies that make large-scale cooperation feasible. Central bank, rule of law, contract enforcement, payment systems, forex markets. These aren't natural. They are human constructions, built over centuries. And they work well enough that we take them for granted. You can travel to another country, exchange currency, and trust that you'll receive fair value. You don't need to know the exchange clerk personally. You don't need to verify their trustworthiness. The system provides assurance. This is remarkable, and it's worth appreciating. We started with a simple question. Why does anyone accept your money? The answer, we've discovered, is layered and complex. Because others will accept it from them. Because institutions support its value. Because mechanisms facilitate its use. Because trade creates demand for it. Because debt requires it for repayment. Because reserves are held in it. Because network effects reinforce its role. Because track records build confidence. Because collectively, we believe in its continued value. Currency value across borders is not a natural phenomenon. It's a social construction, an achievement of institutions, technology, and cooperation. It's also not permanent. It requires maintenance. Sound policies, capable institutions, continued trust. When you hold a dollar bill, or any currency, you're holding a claim on collective human cooperation. A piece of paper that represents value because billions of people agree it represents value. That agreement spans continents, cultures, and political systems. It enables trade, investment, travel, economic growth. It makes modern global civilization possible. The next time you exchange currency, think about what's really happening. You're not just converting one piece of paper for another. You're participating in a vast system of trust that spans the world. You're relying on central banks you'll never meet, on institutions you've never seen, on collective beliefs held by billions. And they're relying on you. Your acceptance of currency reinforces the system. Your trust supports its functioning. This mutual dependence creates the foundation for currency value across borders. We all depend on each other to maintain the collective belief. And because we do, because the belief persists, currency maintains value. It's circular. It's psychological. It's institutional. It's technological. And it's one of humanity's most important and underappreciated achievements. Thank you for taking this journey with me. If you found this exploration valuable, please consider liking and subscribing. It really helps the channel grow and allows me to keep making content like this. And remember, the next time you hold money, any money, you're holding more than paper or digital entries. You're holding a piece of the most complex cooperative system humans have ever built. A system that allows value to flow across borders, across cultures, across thousands of miles. A system built on trust, maintained by institutions, and validated every day by billions of transactions. Currency holds value across borders because we, collectively, make it so. Through our choices, our institutions, our policies, our continued participation in the system. That's the ultimate answer. Not gold, not government decree, not even economic fundamentals alone. But trust, cooperation, collective belief, at a scale unprecedented in human history. Small in any individual transaction, massive in aggregate, and absolutely essential to modern life. Sleep well, knowing that while you rest, $7.5 trillion in currency trades, $65 trillion in international debt requires future currency payments, $12 trillion in reserves supports the system, and billions of people maintain the collective belief that makes it all work. The machinery of trust never stops. The system never sleeps. Currency value persists, sustained by institutions, reinforced by usage, validated by continued acceptance. And now you understand why.